We're joined on Ticker TV today by Resource Analyst Gaius King. Gaius runs the Janus Analysis consultancy and is an experienced resource analyst who's worked at a senior level both here and in Australia. He's well known for his commodities newsletter, which takes a markets practitioner's view of the commodities market. In the first of two webinar-style interviews with Gaius, we focus today on precious metals. Those are gold, silver, platinum and palladium, and all of which are in a bull market, some might say in a bubble. He'll present slides, then I'll take Gaius through the most obvious questions. Here we go. Over to you, Gaius.
Thank you, Donald, for your kind remarks. If we could just jump to the disclaimers, please. Obviously, this presentation has a lot of forward statements. I just point you to this disclaimer and use your own judgment to whether what I say is correct or not. To the next page, please. So what are precious metals? As Donald alluded to, it's gold, silver, platinum, palladium. Gold has gone up 200% plus in the last 2 years. There are only 16 years of reserves left. Silver has been the spectacular one up. It's approached 600% in the last 3 years. This is the sixth year that it's going to be in a primary deficit, i.e. we're using more silver than we're producing. Platinum, its demand has declined 18% over the last decade, but we wrote a note last year saying that last year was going to reach a plateau and grow again. That has happened. In fact, industrial demand will exceed autocatalyst, which is primarily used for at the moment. And palladium has had the unfortunate use of declining in price a lot because we were all going to move to EVs, which apparently is not true. And it's only gone up a meager 170% in the last year and a half. But that actually is a really interesting project, a commodity going forward, and we'll cover that another time. Next page, please. So what is money? Precious metals are obviously hard assets, what we term hard assets. They have tangible value that endures throughout time. And what we have here are gold sovereigns. And there are 4 characteristics of a currency. It's durable. Gold is great. It doesn't corrode. It's divisible. You can have coins of different values, different weights. Transporter, you can give someone a gold sovereign to transact, and you can't counterfeit. And the wonderful thing about gold and silver and other precious metals is that you have to mine them. They're very expensive to mine, and you can't counterfeit. Next page, please. So if we're talking about value and currencies, and I've used here as the US dollar, if you look at history, all currencies eventually fail. But a currency, what is a currency? And effectively, a currency is an asset, a country's asset put towards a medium of exchange. And then there are 3 main pillars. So if you look at the US dollar, which is the reserve currency, it's the size of the American economy. It's the largest in the world. They have the largest military in the world. And the fact that it's politically stable. And if you take one of those pillars away, you lose trust in that currency. If you're going to choose the most important pillar of those 3, it's the military. And as the Romans proved, if you run short of assets or capital, as long as you've got a strong military, you can go and acquire assets somewhere else. Next page, please. And keeping on the Roman theme, I thought I'd have a quick look at the denarii. So at the time of Christ, the Roman denarii was 100% silver, and then over the next 250 years, the silver content in each denarii got less. Now, that wasn't because we were running out of silver. It was because each successive Roman emperor was borrowing so much that when they reforged their coinage with their head on it, they took some of that silver out from the existing coins that they remelted to pay off those debts. And that value still flows on today. So if you look at the Claudius denarii there, these values I got earlier this week, that particular coin's worth about $12,000 US. And you know it's silver because you can see around the edges a yellow patina, which is the silver oxide. And the one beside it is the unfortunate Philip I that basically had no silver in it whatsoever, printed a huge amount of coinage, and the Roman legions couldn't afford to feed themselves, and so they overthrew him. And even today, that's only worth, and you can see the green patina on that coin. That means it's got a lot of copper in it. And even today, that coin's not worth a lot. Next page, please. So what we've done is what is a financial bubble? And what we've done here is we've grabbed 4 distinct periods of different asset classes, for want of a better term. So you have the market crash in 1929, the dot-com bubble with the year 2000, the Nikkei bubble, which is also associated with a property bubble in Japan in the early 90s, and the Poseidon nickel bubble, because there was short of nickel during the Vietnam War. One of the key things I want to point out is that each one of these bubbles has a very large pointy run-up, and then a sharp correction, and then a rebound on the right-hand side before what we term later on as purgatory. Next page, please. And this is the rough model that a lot of people, and certainly us, use, is that you have these amazing run-ups and various people participate at various stages. The 4 points I just want to point out here is what happens when you get to the top. So the plateau, which is the first point, and where we on this diagram call the new paradigm, is where buyers and sellers start matching each other, and the price of that commodity is flat for a brief period of time. Then the initial break, and that's when the sellers overcome and you get a sharp correction downwards on whatever commodity price you're looking at. And then, let's say we're talking about nickel, the price drops 10, 15, 20%, and the buyers go, wow, nickel's really good value, and they start buying in, and you get a rebound. This occurs in every bubble. But it only occurs for a brief period of time, and then the sellers overwhelm the buyers again, and then the term we use is purgatory, but that's when you get the major correction. Next page, please. And who are the investors, and what are the investor types that invest in these bubbles? So personal experience, they can be divided into 2. You get the guys who work on the fundamentals, and they're there early on, and they make 2, 3, 4, maybe 5 times their money, and they think, gosh, we're clever chaps, and they sell and get out. And then you have the true believers, and unfortunately, I have been a true believer at times. I've got friends who are true believers currently, and they will hold from the very bottom all the way to the top and all the way down. And I remember interviewing a geologist at the Poseidon boom, and in the late 60s, he was worth 3 million Australian dollars, which is an extraordinary amount of money these days. And then he went all the way back down and lost everything. And I said to him, why didn't you sell? And he said, because I thought it would go back up. But you also have a group in between, which is also, unfortunately, what I've done, but I've used Sir Isaac Newton. He defined gravity, but he was also an incredibly shrewd investor. He was the first governor of the Bank of England, and he got involved in the South Sea bubble, made a lot of money, sold out, but the bubble just kept participating, getting higher and higher, and all his friends were making money, and he got in at the top. And he lost reputedly about £20,000, which is equivalent to £20 million these days. And that's where his famous quote comes from: I can calculate the motions of heavenly bodies, but not of the madness of man. Next page, please. So should we participate in bubbles? Well, commodities is a series of bubbles, for want of a better term. Commodities are a great way to make money as long as you sell, but they're never a buy and hold. And the example I give here is Newmont. At the crash of 87 to September last year, it took 38 years for the share price of Newmont to get back to its original highs. That's a long period of time, and that's in nominal terms, not in real terms. And I've used the example here of silver. Obviously, some of you have been there. There was a period of time where silver was a hedge against QE, which was new then. There was a debt talks about a ceiling, and inflation fears. A lot of the stories that are going on now, then silver sank away to not much. Inflation occurred in the interim. And here you are, this graph I grabbed a couple of days ago. It's up at around about 118, I think it got to. So these things are, they occur regularly. Okay, next page, please. This is probably a bit of a dig at Warren Buffett. Warren Buffett has been particularly cruel toward gold, particularly in the 2000s and early 2010s. But just to say, there are good reasons why you need to hold gold over a long period of time. It's a store of wealth. The point of this graph is, no offense to Warren, he's an amazing investor. If you just bought gold and not worried about Warren Buffett's Berkshire Hathaway fund, you'd have made more money. Next page, please. Okay, why do we think this market is overcooked? And this is critical. Gold has a relative strength index of 96. That's extreme. That's a 5-decade high. And if you look at an equal weighted index of precious metals, including gold, silver, platinum, palladium, it's up almost 700% over the past 3 years. That's a great rate of return. But I just want to focus on silver here. The Sprott Silver Trust, which holds physical silver, is trading at a discount to spot. That means that the investors in that fund expect the silver price to fall. Otherwise, it would be at a premium. In fact, I've just on my watch list, a lot of the silver stocks I'm keeping an eye on are down 10 to 15% before this morning, so it closed last night, a lot of these American stocks, which means that they are also expecting the silver price to fall. But this is the biggest clincher. Silver trading volumes are through the roof. So silver is trading double that of gold, even though gold is about 15 times larger than the silver market. Silver is trading at 168% of what the NASDAQ is. One commodity. And there are trillion-dollar companies like NVIDIA on NASDAQ. It shouldn't be doing that. In fact, silver volumes are so huge, they're within 9% of the S&P 500. And effectively what that's showing is that people are buying and selling and trading. There's the fear of missing out. This parabolic curve has occurred and everyone wants in. Next page, please. Now, we have been around long enough not to call the top. A year or so ago when we were big bulls on silver and we never saw these eventual prices currently today. No one was interested in silver. But merely to point out that silver was $118 this week. It was $30 a year ago. Recent volatility has been diabolical, especially if you're using leverage. At one particular day, it was up 7%, then it was down 4%, then it was up 6%. So you're getting volatility of over 10% a day. We would not follow this market. We think this market is dangerous at the moment. And to stop losses, we'd put in stops or we'd raise those stops. Or if you're there, make some profits and sell. Next page, please. It's too dangerous to short unless you're very good, which I wouldn't say I am. I work with a colleague who's very good, and he picked it on Monday that it was the peak. Some expert commentariat are suggesting silver is going to get to $350 an ounce. Do we think it's going to get there? Highly unlikely, but you never know. For every ounce of silver, there's 400 ounces of paper being traded. It is a very liquid, speculative market. And there are rumors that Bank of America and Citi have 4.4 billion ounces of short outstanding. Is that true? I don't know. I don't think we can prove it. But that's 5 years of production. But as the Hunt brothers discovered in 1980 when they tried cornering the silver market, all you need to do is just change the rules and issue more paper. And suddenly that short position disappears. But as Bart's reminding us, a short squeeze has unlimited losses if you can't deliver physical. But let's move on. We don't think it's where we need to go there. Next page, please. So what have we learnt with this very brief summary? Commodities are a great way to make money. One of the best ways to make money, I suppose tech's up there at the moment. And in the past 3 years, if you bought various metals, you'd made somewhere between 170 and almost 600%. Currencies always fail. Currencies are designed to depreciate over time. They're not a store of value. The example we've got here is that a bar of gold in 1975 could buy you a house. That same bar of gold would buy you the equivalent house today. That gold, in particular, but others as well, has a value that has a long-standing place in an investment portfolio. Next page, please. Red, obviously letters, means that it's a warning. We believe we're in a precious metals bubble. We think we can quantify that with a number of metrics. Financial bubbles you shouldn't be afraid of. They're a great way to make money as long as you sell. appreciate that. We're not going to try and pick the top, although as of today, maybe we have seen it. But key thing is, if you've made profits, the best way is to preserve them, sell, put in shorts, because when these markets correct, they're so quick and they're so volatile. Trading them is almost impossible. In fact, often you can't even sell. You can't execute the calls. So thank you. I think that's the presentation, Donald.
Thank you, Gaius. Okay, terrific. Let's jump straight in. Beforehand, you told me that gold and silver go hand in hand, that history tells us that 80% of a bull run is led by gold, the final 20% is led by silver. So is that what we're seeing at the moment, Gaius? And are we witnessing the end of a bubble?
Hand on heart, I think we are. And it's something we've been writing about for a long time. Now, just have to quantify those periods. Only cover about a 50-year period. It picks certain bubbles. I think there are only 4 major bubbles. So it's not a hard and fast rule. It's more of a guide. But certainly you're dead on. The first 80% of a precious metals market is led by gold, and the last 20% by silver. We've written in several notes predicting that this market would be over by March. Well, it's not March, it's the 30th of January, 11:43 in the morning. So it's over before, the historical, because there's a certain period that you follow. But yes, that's a fair summation.
Okay. No, it's very interesting. I'm new to gold and even newer to silver, and I tried trading in a silver miner, Fresnillo, but it's almost impossible to trade simply because the share price never settles. Literally, there's so many trades coming in from so many different angles. It literally never settles. I was up 6% in Fresnillo yesterday. I'm down 5% in it today, so I simply sold and I pulled out. Do you think that what are your thoughts on that?
Yeah, look, and this might seem, you have to go back to the presentation of the morphology of the bubble, that the page talked about the morphology of the bubble. When a bubble bursts, you get that initial break where shares fall. Now, trying to pick the top is impossible, and we don't try and do it, but there is redemption. If that bubble morphology is correct, this initial correction will go down to a certain point. People will panic and they'll sell, and a lot of retail sellers will exit as well. But then the buyers will step in because it'll fall, let's say 15, 20%, and then the buyers will step in. Now, typically, if let's say and this is not a hard and fast rule, but it's a guide. Typically, if let's say that initial fall takes 4 days, the rebound, the dead cat bounce or whatever you want to call it, will take 8. And that's the time you should exit. So yes, you're going to make a fall. The market will rebound if it goes according to history. And that's when you want to sell out. You won't get back up to the top. You'll probably get maybe halfway back up. Also, those who are interested in shorting, that's probably the best time to start shorting. You can never pick the top of something, although a shout out to Laurie Shaw, who's a work colleague of mine. He picked the top of silver Monday night, 7 GMT. He sent me a pin thing, and he was dead on. But if you're not as talented as Laurie, and I certainly am not, use that relationship of a sharp fall and a rebound to exit and or to go short.
Okay, let's talk about gold as a potential reserve currency. Is it possible that the $5,000 level becomes the new normal for gold? Does it break the rules of bubbles, or is this a parabolic cycle like any other with a downside? Because gold has different fundamentals to silver.
And look, that's a critical point. So, and in fact, I would go as far as to say that's a fundamental point. And I should just say Donald didn't give me the questions in advance, so I'm thinking on my feet here. If you had asked me 2 decades ago, I would have said that gold was both a commodity and a monetary form. If you ask me today, gold is clearly a monetary form. A lot of banks in the late 90s, when I was working in industry like the Australian and Britain, were sold the gold resources. They treated gold as a commodity. Central banks are buying gold now. They're treating it as a monetary medium. So gold will correct, and yes, it might fall to, it won't probably fall that much, but it might fall to, and I'd have to look at a graph, it might fall to 4.2 or 4.6, 4.8, even 5. Silver, however, and then you got to remember, these are parabolic curves. I would be looking at probably 50 to 55. And the differential between the two, why gold won't probably fall a huge amount and silver will fall a lot more, is that with the exception of Russia, silver is not used by any central bank as a store of medium. Now, I think silver is going to come back, but like gold, it took 2 or 3 decades for it to transform from a commodity monetary medium to a monetary medium. It will take silver the same. So this correction is normal. Silver will still be a buy. It's still demanded in a lot of industrial, 60% of silver is still used in industrial uses. It's not really recycled as much. But in decades to come, silver will become a monetary medium and it will act more like gold. But at the moment, it's still an industrial metal.
Okay. So you think that, and I think you think that Bitcoin can't be a reserve currency, silver in decades to come, but can gold actually replace the US dollar as a reserve currency for the world? I know that, as you say, Eastern European central banks and China have been the big physical buyers. So the World Gold Council tell us.
Look, and I take a different view on that. I think if you read history carefully and you have an economics bent, the only reason why Britain went on a gold reserve, and it would have broken the gold reserve 70 or 80 years earlier than it did in the 1930s under Churchill, or Churchill's idea, is that it came down to discoveries. So you had the Yukon discovery, you had gold discovered in Kalgoorlie, you had gold discovered or the big Witwatersrand, where 50% of the world's gold come from. And that explosion in gold discoveries allowed the British economy, which was growing rapidly, to match its economy with the amount of gold supply. We can never go back onto the gold supply ever again because the global economy is too large for the supply of gold available. And in fact, that was the problem that BRICS, when they were going to set up a payment system, with the exception of the US dollar, there wasn't enough gold, and there wasn't enough silver, and there wasn't enough good quality debt to make that payment system. So everyone was sort of stuck with the US dollar as a byproduct. You briefly mentioned Bitcoin. We did a course at Oxford on ledger technology, and at the end of that course, 6 years ago, I was convinced that Bitcoin was going to turn out to be a bit of a nothing. Now, if I was really smart, I would have bought Bitcoin and made a lot of money going in the interim. But the reason why I came to that conclusion was because it has no asset backing. The US dollar, its asset backing is the US economy. It's a US military. It's a stable system. The problem with, obviously, debt is a real problem with the US dollar, but there are hard assets behind the US dollar. It's not just paper floating in space. The US dollar actually means something. So,
If I could intervene there, Trump is very keen on a depreciating dollar, though, because it allows him to export goods more cheaply, and that's what he cares about. And if it causes higher inflation in the States, then he's also pleased with that because it gets rid of his debt. What are your thoughts on that, Gaius?
And it works. So at the end of the Second World War, Britain owed a huge amount of money to the US. The US being a mercantile nation, it wasn't there for the benefit of the UK, despite what many people think. And the UK took a deliberate policy to depreciate the pound so they could pay that debt back. And I think I actually remember when that debt was finally paid back, and it wasn't that long ago. So yes, that is a good strategy. Is it a good long-term strategy? Like the denarii I was pointing out with the Roman Empire, you can depreciate your currency only to a certain point. And countries like Turkey and and Venezuela and needless to say, maybe Mugabe's regime can prove the limits of that. So yes, the Trump and successive presidents for maybe another decade or 50 years can keep playing that game and making the US more competitive on an international basis. But fundamentally, when you lose your reserve status, the US dollar, it costs you a lot more to borrow.
Okay. Now we're here today to talk about how to make money in this particular market. So gold, silver, platinum, palladium. How do you actually play these? Would you actually play them? And if so, how? I mean, put it in context for us. How would you do it?
Okay, so I'll bring in a couple of other things too. At the moment, I think gold and silver are going to correct. If you are capable and talented enough or know enough about the market, maybe you could short them after the next rebound. Or maybe if you've made a lot of money, put that money away, because history shows that between each one of these spikes there's a long period of inactivity. But, commodities is not just gold and silver. If you look at the demand profiles for things like nickel, aluminium, zinc, and a host of other commodities, copper.
But let's talk within today's. We'll deal with these later. But within today's talk, we're talking about what about palladium and platinum? What are your thoughts on those?
Platinum and palladium, I'm quite bullish on those, simply because they have industrial uses. So if we just take palladium, for instance, it has a high oxidation temperature. So that's why you use palladium primarily in autocatalysts with petrol engines that have higher temperatures than diesels. 75% of palladium is mined. Most of that comes from Russia. On a note that we did recently, most of that comes from a single place called the Norilsk Nickel Complex that's been mined since the 1920s, 30s. It appears that supply has been supplemented by Russian stores. When those stores run out, there is no real substitute. You're going to have to open other operations, either in South Africa or maybe something like Chalice in Australia or something like that. So there are real shortages of platinum group elements coming down the line.
How do you actually invest in it, though?
Sorry?
How do you invest in it?
I would buy the companies because that's where the greatest leverage is. In this recent bubble, you'd have been better off buying the commodities, the underlying commodities, but that only occurs when there's a bubble. If it's a long-term sustainable thing, the greater leverage is to buy the gold or mining company, because you're producing cash flow. This bubble was always going to be too short for mining companies to really make any big differences out of. So yeah, I'd buy mining companies. There are good South African companies that have platinum palladium exposure.
Okay, that's very interesting. Next time. Now we can talk about this. Next time we're going to talk about copper, aluminium, uranium, zinc, all commodities which you think are highly investable, and they're at the beginning of a major re-rating. So tell us what your thoughts are on those, please, Gaius.
I would go further than say a re-rating. I would talk about, and some of the notes we've written, there are 1.6 billion people starting to develop in economies around the world that have the average economic growth rate of 6 or 7%. Individually, they're small, but together collectively, they're incremental. And there are a number of assumptions that we've made. For instance, iron ore, that we thought prices would fall over by now. We have been wrong. And the reason why we've been wrong is that we've underestimated all these economies coming up. That's not including India. In the next 3 to 4 decades, India will replicate the entire EU's electrical grid. That's not including the copper that they will need to put into new buildings. So that's 1.4 billion. So you get the 1.6 billion of other economies like Indonesia and Nigeria and Bangladesh and Pakistan, and you put those with India, suddenly you're talking 3 billion people over the next 4 decades that are going to develop and are going to be metals intensive. And what we're calling is commodity cycle Mark II. It's going to be like China in 2003, 2004, but just bigger.
And these commodities are beginning to run, you say?
They are running, indeed. They're running now.
So now is a good time to actually be getting in sort of what you might think of as the bottom if you're a long-term holder.
We only have to look at the prices of, forget the small and the mid tiers, you only have to look at prices like South 32, BHP, Rio. They're all running, and they're running on iron ore, which shouldn't be bullish at all. Well over 50% of BHP's EBITDA is iron ore. When you get to Rio Tinto, it's almost 80% Australian iron ore. These companies are not very well diversified at all. Yes, they have some copper, but that doesn't really hit the bottom line. That's an iron ore, and that's probably the most bearish I've been on. That's the bearish commodity I've been on for quite a while. Coking coal has suddenly picked up. Coking coal is a key need to make steel. China's internal steel consumption peaked about 4 or 5 years ago. Its housing property cycles come off, but it's now exporting steel all around the world. It's now turning. China runs a surplus of 1.2 trillion per annum. It's now exporting materials all over the world. It's not just a China story anymore. It's a global world development story.
My final thought, my last question, uranium. Discuss.
Uranium, discuss. Uranium, good question. Uranium, and this is not a widespread opinion, but this is my opinion. Uranium is really down to government policy. Uranium is not demand supply story so much. It's about government policy. Germany decided it wasn't going to go in uranium anymore. Donald Trump is going to quadruple uranium production in the US, baseload. That means, according to our numbers, that if that goes through by 2050, 60% it's about 50-something% of US electricity production will be nuclear power, and that will account for over 60% of the global uranium industry. So the uranium industry is going to be a US industry. And actually, uranium is very hard to find. There are only a few places in the world to find it. So there's going to be a new uranium bull market coming up. And it's going to be a US story.
You heard it here first. Gaius King, resource analyst at the Janus Analysis consultancy. That's it. We're out of time. That's been absolutely fantastic. Thank you so much for your historical overview and for your current thoughts. You've shared your wisdom with us. Thank you. In a few weeks, we'll be back here to discuss all those last commodities that we mentioned, and we look forward to that. So do subscribe to the Ticker TV channel. Come back and listen to what Gaius has to say in a few weeks' time, and we'll see you then. Thank you very much indeed.
Thank you.